Vikram Limar, MD and CEO at IDFC, joins us on the show right now. Vikram, hi, morning. Do you see high interest rates still continuing for at least next 6 months, and hence do you see interest rates environment impacting companies in the infrastructure sector?
On interest rates, I think rates will remain elevated, but I do see the short end coming down. We've already seen some of that happen. And I think, as the Reserve Bank governor indicated, if they're going to try and bridge the gap between the repo rate and the MSF rate by another 100 basis points, you will see some reduction in short-term rates even in the next 3 months. So I think short rates will come down. I think the long rates will probably remain where they are, given that inflation is quite sticky, and inflation control is clearly the priority of the Reserve Bank.
Vikram, banks currently are clearly suffering. In fact, most of the banks, they've gone on record and they've indicated that, look, we want to reduce our exposure to core sectors. Is that a blessing in disguise for a company like IDFC? Are you gaining because banks are lending less?
The reality is that there hasn't really been any new project activity for some time, whether it's power or roads or any other sector. So from that standpoint, I don't think it's an issue of banks being risk averse and therefore a larger landscape being available for us. The reality is that from a growth perspective, the new project pipeline is actually quite weak, and that's been the case for over a year now. So I don't think that really increases the opportunity for IDFC per se. I think everybody in general has become a lot more risk averse, and people are trying to figure out low risk ways of growing. And in that context, I think for high quality borrowers, therefore, the landscape will continue to remain exceedingly competitive amongst the lenders.
So are you worried about core sectors, energy, transportation, telecom? They are not growing, and these are 3 core sectors where you lend.
Yeah, so as we've said for some time, I think unless some of the uncertainties that we've been talking about for a while get resolved, I don't think new investment activity is likely to pick up. And the reality is now most people are on wait and watch mode for the election outcome, in addition to the uncertainties being resolved in each of these sectors, and they have different issues. Each of the sectors that you mentioned have different issues. What I will say is that over the last 6 months, there's been progress in terms of announcements by government, the Cabinet Committee on Investment stepping in to try and resolve some of the issues. So in all the sectors that you mentioned, there has been progress, whether it's coal-based power plants, whether it's the recommendations of TRAI on spectrum pricing, and also the discussions that are ongoing between NHAI and developers surrounding back-ending of premium for road projects, so that it frees up cash flow and equity needs of developers for roads. So I think all these are positive developments. At the margin, you are seeing projects that have been delayed because of clearances, etc., getting clearances, whether it's from the environmental forest clearance standpoint or because of the Cabinet Committee on Investments intervening in some of these projects. So I think over the last 6 months, clearly there has been improvement. But if the question is surrounding new project activity, then that I think will happen only with a lag after the existing projects have got all their clearances and confidence comes back post-elections.
So, I mean, Vikram, what's going to be the focus then over, say, the next 1 to 2 years? And are you guys at IDFC looking to diversify lending your book to other sectors as well than what we've already talked about?
As we talked about our own plans, including, why we thought that banking would be the right structure for us long term. One of the things that we mentioned was important was asset diversification, and that's primarily from a growth perspective as well as from a risk perspective. So whether we go down the banking path and whether we get a banking license or not, time will tell. If for some reason we don't get a banking license, we will still need to diversify our asset base, because that from a long-term growth and risk perspective is the right outcome for the organization. So yes, we will have to diversify beyond infrastructure.
Vikram, many experts or many analysts who track IDFC stock are of the view that if you get a banking license, that could be a short-term negative and more like a long-term positive, because in the short term you will only destroy capital and capital needs will only go up because of expansion.
It's not so much about expansion. I think it's quite clear that you have to comply with CRR, SLR, and priority sector norms, and the impact of that will be negative in the short term on ROE. So that we've been quite transparent about. So it's not about expansion. It has more to do with the regulatory framework of banks, and therefore what kind of returns you can expect in the near term, because you have to comply with CRR, SLR, and priority sector norms. But I think over the long term, as you rightly pointed out, if that's the right framework, then from a shareholder value creation as an organization and as management, we have to think about the long term.
Vikram, what spooked your stock of late was when you tweaked the FI limit for IDFC. So what is the current FI limit in IDFC, and what is the current FI investment in IDFC?
The FI limit, we had to cap at 54% because at that point in time, the FII holding was a little north of 53%, and the new bank guidelines indicate that licensees have to be, the foreign ownership in new banks will have to be less than 50%. So we wanted to make sure that the FII limit is at a manageable level, such that if we were to get a bank license, we were able to bring it down below 50%. That was the reason why we did it, and I think investors, etc., were aware of that, because this was outlined long before it actually happened. I think today, so the FI limit is 54%, and foreign ownership in IDFC is about 50%. So there is enough room for FII investments within the limit that has been put.
Just to get it right, if you get the bank license, will that automatically force FIs to reduce their position to sub 50%?
No, so, if we are north of 50%, we have to figure out a way to get it below 50%. And, that can be through a combination of different things. It doesn't have to be, we have to figure out domestic shareholding to go up for the incremental amount above 50% that's owned by foreign owners. So I think we'll figure out a solution around that. I don't think it's that complex. And given that right now we're at 50%, it's not a huge task in terms of figuring out 1 or 2% that needs to be owned by domestic investors.
Vikram, there's heightened concern and fear really in the markets as to how this earnings season is going to pan out in terms of asset quality stresses. Where do you think is the most amount of pressure sectorally?
I think obviously if you were to think broadly from an economic perspective, then I would say that obviously the sectors that have high leverage would be susceptible to some issues and some stress. That would include infrastructure, that would include real estate. I think the SME related areas will also face some stress, because in a low growth, high interest rate environment, the smaller companies tend to get squeezed out by the lending community, access to capital, as well as within the supply chain, delays surrounding payments, etc., etc. So I think broadly, if I were to categorize, I think the areas that have leverage would face some stress: infrastructure, real estate, other capex intensive areas, and the SME area. I think rural, agri, and retail are holding up okay.
Let's talk about your fee-based income. What is your guidance for your fee-based income? Because that piece of the business for IDFC in last 3 or 4 years has done rather well.
Yeah, the fee-based income streams are really, 3 or 4 different streams. So we have an alternatives business, which has our infrastructure funds and our private equity funds. I think that stream will remain steady, if not grow, because we've just announced first close of a new infrastructure fund where we've announced first close of $644 million in a very difficult environment. I think the final close on that fund could be anywhere between $800 to $1 billion. So that will result in incremental fees. The asset management business on the public market side is also doing well in terms of market share and the performance of funds, etc. So broadly, the asset management fees comprising the alternatives business as well as the public markets business will remain steady, if not grow. I think the investment banking broking business is facing headwinds, which is the case generally speaking, globally or domestically, for the industry as a whole. And so that revenue stream will remain volatile. We don't expect much growth relative to the fees that we got last year from that business. I think the loan-related fees again will be lower than what we had last year, primarily because the loan growth is much lower than last year, and so that will generally track what happens with loan growth and balance sheet growth. So overall, and then the last element of that is, any principal gains that we book on investments that we've made. And again, on that, it's really a function of markets and valuation in terms of what we're able to monetize, because we really need stable markets and appropriate valuations for us to take money off the table on investments that we've made. So that generally tends to be volatile, but in weak markets, obviously, it's more difficult and challenging to monetize investments. So that's broadly the mix of our non-interest income revenue streams. So I think a couple of streams will do well and a couple will remain challenging. Overall, I think what we've guided...
Right. Vikram, we are completely running out of time, and I know we've extended our appointment with you. So one final question. Finance Minister a week ago indicated that he wants the new banks to be differentiated. He does not want the new banks to be clones of each other. So what is your key differentiation? It is certainly not reach.
No, so I think, the differentiation is the following. One is that obviously we have significant expertise in infrastructure, and even after getting into banking, we will continue to service our infrastructure clients with a much broader product suite. So we will be more effective in servicing infrastructure as a bank rather than as a non-bank. And the second thing I would say is that, there is an opportunity for a new bank to reimagine how we do inclusion, more as an opportunity and as something that is commercially viable rather than a regulatory obligation, because we don't really have any baggage of branches, technology, any of the hard infrastructure that many of the others have put into place. And there's been quite a dramatic evolution of the ecosystem, whether it's regulatorily, connectivity through telecom, development of technology, etc., etc. So we will be able to take advantage of many of those things to be able to, achieve the inclusion objectives in a differentiated way, as opposed to what has transpired so far. That's clearly our ambition and our hope.